Tim Quast, how was your weekend, sir?
It was great. It was I had a wedding anniversary over the weekend.
Oh,
So
congratulations.
I am the most fortunate man on the planet. I am amazed every day that the beautiful woman that I get to share life with puts up with me.
How many years, Tim? Let me guess. Let me guess. See, I don't want to make you
This
look
is always a dangerous
Yeah.
game.
You're
I
playing
wanted
a
to
dangerous
warn
game
you.
here, Joel.
He's younger than
Dangerous
me.
gambit.
He's younger than me. Is this number one or number
He's
two?
much younger than you, Joel. He's not even in your realm.
And we did all of this,
25.
Spencer, to deflect attention.
20,
you
25.
needed me to do
25.
that. If I had met Karen 25 years earlier than I did, it would be 37.
Okay.
But because I'm not very bright, it took me 20 years to find her.
Okay.
Oh.
When I did, I realized my good fortune and blessings.
Okay.
But before that, and
You hit the bed right away.
Took me a while. That's all. Yeah.
Actually,
So it's a
lifted the
dozen
offer.
years. It was 12 on the 12th. Yep,
Baker's.
that
And
one.
what is the
Whoa.
special thing that you've like? I get the thing every year for the anniversary, starting with 1,
Okay.
2. There's a special, there's
Right.
obviously the silver and the gold. What is
Right.
it for 12? What special gift did you get your wife representing the 12th anniversary?
A large David Yurman ring. That's what I got.
Ooh, I don't know
Yes,
if that's it.
yes,
Yeah. Yep.
That's what it is. It's the Yurman ring anniversary. The 12th is, yes.
And
Yeah.
one more thing, and then we'll let you do your stuff. Is that an NFT behind you?
It is, and
It
you
is.
can. We're actually auctioning it off on the show
1.6.
today. Yes.
Oh, excellent. This is an
Right.
NFT.
Speaking of which, there's
Take
a
the
great
snapshot of it. You get Tim.
right.
You
right.
get Tim.
It doesn't
Picture
actually
in front
exist.
of the picture as an NFT.
But right, that's it. Well, it's funny that you mentioned that. There's a column in the Wall Street Journal by Andy Kessler, who is a hoot. I tend to like what he writes, but he was talking about the just bizarre valuations. How Carvana is worth more than Volvo, Ford, a bunch of car companies. He went through all this whole litany of things in which the valuations are crazy. But he also mentioned how there was a invisible statue auctioned off for $18,000.
I saw that.
That doesn't even exist, and somebody paid $18,000 for it. So I'm sure it'll all work out. Everything's fine.
Yeah.
But
You
All right,
can
so
get a
Tim-
cup. I'll give you a cup
Yes.
of air from in here. You want to auction that off here too? Here's a cup of air.
Dennis's air.
Yeah, you
if
can
you
breathe
bid-
my
bid-
air. I hope I
bid
don't have
early
COVID,
and
'cause that'd be a
often,
bad
right.
auction.
So
Right.
Tim, what's on your radar for the week as far as markets are concerned?
Well, as you know, Congress is in session and options expire. So it'll be, that'll be an interesting confluence of events. I think it was Benjamin Franklin who said the certainties in life, the only two certainties in life are
I
death
heard
and
that.
taxes.
Yep.
Right. And then Will Rogers, here's a name that probably your audience doesn't know, expounded upon that and said, the difference between death and taxes is that death doesn't get worse every time Congress is in session. So you can ponder that. That's pretty good, actually. That's a pretty good line. Here's what we're thinking about, Spencer, and I hinted at it. The options expire this week, starting Wednesday, Thursday, Friday. So you have VIX expirations, and that isn't just the VIX. It's not just volatility. The fear gauge, the measure of the implied volatility of the S&P 500, but it's the volatility as an asset class instruments. So it's always a nice peg. You can figure out, well, are people wanting to be more conservative, or are they going to take more risk? In August, it was apparent on the 18th of August when VIX expirations hit last time and the market dropped that people were less interested in volatility hedges. That's what it means. It's not a negative. It means that money is very likely to pursue things like Tesla. And so it'll be interesting. Thursday come index options expirations AM dated, and then Friday is quad witching. I like to, I've said this before, that unknown things occur during these periods. And so I like to look at two things. What is the general direction of the demand trends across the market. And we talk about that with Edge, that you can measure all of those things. You can see where the money is going. And then number two, because the unknown can occur, things that occur over the market, OTC, happen during those periods of time. I prefer to portage around those rapids. And here's the way to think about this. The market, if you measure it by the S&P 500, is up in 2021. Let's call it about 21%, depending on what happens today. But if you were to tally the ups and downs in the market, the market has moved significantly more than that. If you take out the pieces of down periods, it's very interesting to do this, and it's simple math. So the market has declined 42% around options expirations in 2021.
Wow.
So imagine if you skip those. Just imagine if you were to skip those and come back into the stream at a price better by 3 or 4% every single time that they hit than everybody else.
Pretty good return.
It's a pretty good return. It's a way to think about it. Well, I look at that, and not being the brightest fellow, but at least being observant, I would say to myself, let's avoid those. So maybe here's what I'll do, Spencer, and I'll pause here so that you can, I've done a lot of yammering there, but I'm going to show you these trend lines as we measure them with Market Structure Edge. By the way, it's marketstructureedge.com. You guys can follow, you guys know this. You can follow along if you want to. So here's the dashboard at marketstructureedge.com. By the way, notice this. You've been invited to preview Beta 2.0. It's out. We have been working furiously on that. Our engineers have. We had our final meeting on it last week. So if I were to, I'm going to get rid of this sort. So the sort right now is just giving me, we're going to look at this. Here's EV. You were just talking about EV. So let's look at where EV is right now. The top line is the demand trend. So it will go for, above 5 is good, below 5 not good. There aren't returns below 5. When the demand side is rising and the supply side, short volume, is falling, stocks tend to do well. Well, that group had a good finish to August. That was a good time to trade things like Nikola. Look at it now. The demand trend is falling and the supply side is rising into options expirations. Well, the prudent foresee evil and hide themselves. Just hop around that and wait for those trends to turn. No matter how much you may think EV stocks are good to buy, wait until the supply-demand equation gives you an advantage, a probability, then you will do better. There are only so many stocks in the market. You will not outperform the market by owning things other people don't own. 1,000 stocks are 95% of all market capitalization. The way that you win in the market is avoiding pitfalls and taking advantage of probabilities where demand is increasing. And the beautiful thing about that, folks, is that it eliminates the concern about valuation. We could talk all day about whether the market is appropriately valued. But what really matters is supply and demand. What is money willing to pay? And this will help you understand that. So that's my comment, Spencer. That's where we are. I want to show you one other little piece of data here. Well, it's not really a little piece of data. It seems very, very weedy and arcane. So this is stuff we do internally. Okay. And what this is telling us is all the green bars are days where the market where there is net buying in a group of stocks. This is the 11 sectors making up the market. So we like to measure how stocks behave relative to midpoint. If the entire group closes above the midpoint, we know that money is coming into that group. If the group closes below the midpoint, it tells us that money's trying to leave. You may not see that in the basket that is used to measure the group. For instance, if you look at communication services, the communication services ETF includes only 26 elements. Well, there are 150 stocks in the communication services group, which includes Facebook and Netflix and so on. So
wait, just real fast. What is this now? Are we looking at indexes? Are we looking at?
We are looking at the stocks comprising each of these sectors. So we're seeing the entire market. So the problem with the broad measures, like the Dow Jones Industrial Average, it's 30 stocks.
Right.
except there are 3,450 stocks that comprise the national market system. There are only about 2,500 in the Wilshire 5,000, because those are all that meet those criteria. But we can then measure all the money. What's the money doing? Well, around options expirations in August, look at all the green. Everywhere you look, this is healthcare, this is financials, this is consumer discretionary, here's communication services. So that would tell us the market would do well because it's cause and effect. Now look at it. I mean, this is blood red everywhere. It is actually the worst of 2021. The only time that compares to it was June. And June was bad, right? So if I look at, here's materials, imploded, even real estate. I said last week, well, real estate was the best place to be. Why did I say it? Well, look at all the green. But that came apart at the seams Thursday and Friday of last week. And it was active money that sold that group. It wasn't passive money. So if I look at all this data and all the red on the right side of the graph, it tells me I should avoid the market no matter what it does today. The reason the market will be up today, if it even finishes up, is because there are very cheap baskets of options to buy. So I'll tell you, as you options traders know, there is time decay. And there's a Greek term for it. I think it's theta. I don't pay attention to those terms. But I do know this, that there will be an effort on the part of high-speed traders who are very good and faster than everybody else to say, where do I get the best discount on these options? I'll buy up a basket, and then I'm going to run prices in that group in the hopes of selling my basket to somebody else by Friday morning at the latest. But this will play out this week. We warned everybody at Edge in our market desk note so that you will understand that it's not fundamental. There's a reason why this is occurring, and the prudent should beware of it. I'm not gonna go chase stuff this week because I can see all the blood red there, right? Why would I do that? So
isn't this information like a little bit, to some extent, a little bit obvious though? Like there are more sellers than buyers last week. That's right. Duh.
Well, right. not necessarily.
Right, right. The market went down. Why? Because there are more sellers than buyers.
That's not. There's always. It's funny, you know. You can say there's more sellers than buyers, and more buyers than sellers. But there's a buyer for every seller and a seller for every buyer. So when people actually say that, it's technically not true.
Okay.
I would say it's more active buyers that are lifting offers as opposed to, you know, so the active money, the passive money. I think that's where we bring Tim in here too.
Yeah.
Is because he's looking for where that active money is going to be moving into. Where is the demand rising? Because you have passive, you know, sellers, you know, even market makers to a certain extent, but there's passive all the time. But there's other passive out there. It's the active money that really moves it. So just necessarily saying there's more buyers than sellers is never true, because there's a seller for every buyer.
Exactly. And really, Spencer, if we look at the data here for the S&P 500, this is what happened in the 5 days ended September 10th, Friday. Here's the composition of the S&P 500. That's the volume. So 9% of it came from active money, 21% from passive, over 50% from fast trading, and 19% from risk management. And investment behavior was actually down. So there were not more sellers than buyers. What happened is that all the people making bets with derivatives shifted short. See this? An 8% increase in short volume as a component of overall volume. 44% of the market was short, and the leading behavior of only 50 basis points. Realize this. Nothing moved much. That tells us there were a lot of marketable trades. If there's a big change in the percentages, that tells us there are actual buyers and sellers. Here, it's just everybody hitting the bid in the offer. But the only behavior to increase materially was risk management and the machines that amplify those moves and who know how the tick is changing. So if this suddenly becomes actual selling, then we have trouble, right? So this is what we watch. It tells me I don't want to compete with machines. I'm not fast enough. But I can beat them by knowing the supply-demand balance, which they don't pay attention to because they're too close to the tick. That's what we do with Edge. We want to take a long step back and say, we want to observe how those things hit supply and demand. And I could scroll all the way across this dashboard, and I would see everywhere, almost every single trend line is down, save what I have here for us. The only thing showing a demand line up and a supply line down is what I put in our Benzinga pre-market prep portfolio, because that's the only stuff I'd be interested in. I'm only interested in things that are running opposite to the trend lines in the market. And even that doesn't make me comfortable because it can get run over.
One thing I just want to expound on both Tim and Dennis's points is, there's times when you can feel like when the market's going up, like it went up last week, it kind of like it's going up today. There's there's offers there, right? It seems like institutions, they're always willing, they always have targets. They're always looking to, hey, if I could sell 200,000 Apple at 154, that's a quarter of my position. And so they're selling into strength. Their offers there, like, come and get me. This is where I want to sell it. And then you feel those days like that. Now, a day like Friday, people are selling on weakness and there's less bids in the market. And so you get those down slopes. And of course you have the buyers that step up, but it's just selling into strength as opposed to like a day like, and it even kind of feels like today, like the guys that didn't panic, the guys that did sell on the close. 9/11, we're going to open 40 handles lower. They're like, okay, I'm getting a 30-point premium to where the SPOOs closed on Friday. My number's 44.70, and they'll work it. So it's different dynamics. And Tim, I think your numbers kind of like sniff out everybody, the strong sellers, the strong buyers. And no, I think just taking both your points into account there, I just wanted to throw that in there.
Well, guys, and I agree with you entirely that I think it's important to know that the market moves according to the bid and the offer. That is it's a central point. And who sets those? Well, we just looked at the data. Over 50% of the time, those are coming from people who don't want to own anything at the end of the day. So if the buy-sell balance begins to tip against them, that's how the market goes down, just falls apart in the last hour. If machines that don't want to own anything go, wow, the bid is and the offer is moving against me, I'm pulling my bids. And that's how you get May 6, 2010, a flash crash. If machines that get these exemptions to make markets, all that a market maker like Citadel cares about is making a tiny tenth of a penny profit on the difference between bids and offers and supply and demand. That's what they're doing. But if they see those things begin to tilt against them, they're out. And that's how the market can suddenly move without any real buyers or sellers. Yeah. It doesn't take much for that to happen.
All right, Tim Quast joins the show every Monday at 8:35 to give us his thoughts on the market and who's doing what. Tim, pleasure as always.
Talk to you guys
next Monday. MarketStructure8.com, guys, to learn more about Tim's product and how it works and how they view the markets.